Now to our panel. Strategist is Chris Ferrone, JP Morgan Private Bank, Abby Yoder, and Schwab's Kevin Gordon. It's good to have everybody here. Abby, I'll begin with you. I mean, anything incrementally positive on the China trade front is going to be well regarded by this market.
Yeah. I mean, if we think about, we haven't had major down moves in like 120 days, something like that. It's been a really long time.
Yep.
We did have that negative 2.5% move that Friday where it was announced where this, this trade tit for tat came back. And I think, it was viewed as, okay, this is not only an embargo from an economic standpoint, but this is really hitting the AI trade, right? With the rare earth materials, like that's what was really unraveling the market. This was a double whammy in that it was going to result in really hard hit to economic growth and then also the AI trade, which has been obviously a big component of the S&P 500's return.
The market had turned its attention away kind of from trade, until the Friday sort of blow up in the market. So it's still out there, but the market feels like it's eyeing other prizes. Good economy, good earnings, and rate cuts. Is that right?
Yeah, I would say that. I mean, I think over the past couple of days, I'm sure we're going to get into this, that like you've seen a little bit of an unwind from a momentum perspective, and that's something that I think probably has something to do with the fact that we're getting our first piece of government data in a month or so tomorrow. So I think there's some jitters around that. And I think it's also, October tends to be a little bit more difficult for the stock market. Next week, we have a ton of earnings, particularly from, the large cap tech and AI related names. And so I think there's a little bit of hesitancy to, into year end, like maybe take some profits on what has worked and rotate into stuff that hasn't. And that's why you're seeing defensives outperform in October.
What do you think?
Well, listen, I think
match up with your view?
Yeah, it does. I think when you look seasonally, we're at the point of the calendar where you actually want to lean into what has worked. When you think about what are the two big risks out there, you bring up one, China trade. I thought it was very notable 2 Fridays ago on the Trump tweet, what didn't move? CNH. Remarkably calm. That has always been a good barometer of when there's headline risk or real risk. We see headline risk, not material risk here. And then you think about what are the domestic concerns out there. We've seen this spat of bankruptcies, but high yield CDX is still relatively calm here. You're not seeing the real deterioration of the credit markets nor consumer stocks. If anything, consumer stocks may be reaccelerating here after taking the last 6-8 weeks off. So I'm still pretty comfortable with the view here. I do think there are some things to be mindful of. The banks have started to act maybe a touch weaker, but on balance, I still think we lean into strength here into year end.
I think Abby brings up momentum in the perfect way for us to discuss that, because the unwind, there is a debate as to whether it's over or running, its course. It's on track for its first negative month in the past 7. It's on pace to be down 4 weeks in 5. You've had some pretty good declines in the names out of the MTUM. And Jeffries today asks the question, should it be bought? Morgan Stanley answers and says, well, it's only halfway there. What do you think?
Well, I think what's important is in this little 4 or 5 week momentum unwind that we've been in, the market's still up. Right? So we've had this rotational move, not this outright distribution. And you look at even yesterday as a good example. There was a point yesterday where the S&P was down 50, 60, 70 handles. Breadth was actually positive for much of the day. So you haven't seen what's become a little bit of a momentum shakeout really migrate to the other corners of the market. If anything, there are pockets that are getting better. Healthcare has inflected in our work. Discretionary is turning back up here. Industrials are still largely in pretty good shape. So I don't think the momentum unwind here is really infecting the broader picture. And speaking of, when you look globally, China new high, Japan new high, Europe new high, you're not seeing it infect the global markets here either.
Kev, I'm glad that point was brought up about like healthcare. Some say, well, if healthcare and utilities and at one point staples were the 3 leading groups over the last month, that's not exactly the most bullish sign in the near term for stocks. How would you counter that?
Well, I would back it up to a little bit further, maybe over the past year or two, where utilities has really pulled away from healthcare and staples and not really being a defensive sector. It sort of shed that status, and I think a lot of that is presumably tied to anything power and AI related. So I think that to the extent you look at staples in healthcare as any kind of signal or yellow flag for the economy, I wouldn't take a month or a couple of months of some outperformance from healthcare, for instance, as some sort of yellow flag. I think that, this whole point about momentum and the discussion about it, I think is important because this year's market so far, if you overlay it with 2020 into 2021, there are a lot of similarities in terms of a lot of the speculative froth and behavior that's going on in certain segments and certain pockets, but it's very confined and isolated to just those. To Chris's point about breadth holding up relatively well, even though we've gone through some of these bumps and rotations lately, I mean, you really haven't breached durably that 60% level for the percentage of companies in the S&P above their their 200-day moving average. As long as you don't get those negative divergences where the index is moving higher but breadth is deteriorating, then you can continue and I think churn in a positive way where this really just looks more like a consolidation over the past month, doesn't necessarily look as corrective.